Hey everybody, welcome back. So this is actually going to be part two of a four-part series that I'm putting together on trading options in Robinhood for beginners. This is again part two, where we're going to talk specifically about the premium that each option contract has. So we're going to dive into the premium section and really talk about the multiple parts of that and what makes up the premium. So if you haven't seen part one of this, please go back and click the link up at the top. This will take you right to the actual video for part one. And again, this is part two of a part four series. So welcome and enjoy. Okay, so we're going to talk about the premium portion of these options contracts. So in part one, we talked about what an option is. We're going to focus again on just being the buyer, and we're going to focus on calls. We're not going to focus on being a seller or dealing with puts at this point. We're going to use the same example, DraftKings. We have the same screen up that we're going to walk through as well. But this time, instead of talking about the actual strike price, which we had covered before, we're going to focus on this, the premium. Okay, so in the first video, we actually talked about how if you buy the option and then sell it right away, you would receive a credit because you bought it in the money. You bought it at a strike price that was less than the current trading price. In our previous example, it was you bought them for $50 and then you sold them for $51.20. You made a $120 profit. In this example, we're going to talk about the premium that you're going to pay, right? So you can't just buy something that's trading, buy something cheaper than what it's trading at for nothing, right? So there's a part of this that gets a little bit more complex in how this works. Otherwise, everybody would be trading options. Everybody would be making a ton of money, right? It would be easy, right? Trading options is not necessarily easy to do. But that's the point of these videos, helping you understand a little bit more at a time. Okay, so let's take this. We're going to focus on this $50 call that we're going to buy, okay? And we'll start with the premium. This is the premium. All right. And the premium here is $5.50. Now, again, that's a premium per share. Now remember, an options contract is for 100 shares. But for simplicity reasons and keeping this, to smaller numbers, we're going to focus on just the premium amount. So remember, you're going to be paying $550 to buy this option. Again, you're just buying the right to buy 100 shares. You're not obligated to. So you pay $550 to buy this options contract at the $50 strike price. So this premium can actually be broken up into two different parts. First one is called intrinsic value. The other part is called extrinsic value. Okay, so intrinsic value and extrinsic value. Now, the intrinsic value is if you were to buy this option and then resell it immediately, that is the amount of money from this premium that you would make. So in this example, if we bought the $50 and sold it at the $51.20 current trading price, right? So if we bought it at the 50 and sold it at 51.20, the intrinsic value would be $1.20. Now, what's left over is considered extrinsic value, right? So 550 minus 120 is $4.30. So if you bought and sold immediately, you would earn the intrinsic value of $1.20 per share, which is $120. But you would also be debited the extrinsic value of $4.30 per share, which would be $430. Now, keep in mind that this has intrinsic value because we are buying in the money options. If we were to buy out of the money options, there would be no intrinsic value. So out of the money, no intrinsic value. Okay, keep that in mind. So the reason that the in the money options have intrinsic values because the strike price is less than the current trading price of the underlying stock. So that is how intrinsic value is calculated, right? So it's in the money options, it's the current share price minus the strike price of the option times 100, you get your intrinsic value. Extrinsic value, right, is the difference in the premium minus the intrinsic value. Now, how does that extrinsic value get calculated? I don't want to go into a whole series of information and details around how this is calculated, but I'll give you the information from a conceptual standpoint. So extrinsic value is calculated because of really two things. TTM, time to maturity, as well as implied volatility. Okay, now time to maturity is how much time is left until this contract expires. So you can see the expiration date on this contract is January 29, 2021. Now, it depends on when you're watching this, but as of right now, today is December 16th, so it has a little bit over a month, maybe a month and a half, till it expires. So the time to maturity plus implied volatility. Now, implied volatility is how active this option is being traded at. Okay, and we'll get into a little bit more about what implied volatility is in the next section, but for right now, just understand that extrinsic value is calculated with time to maturity and implied volatility. So both intrinsic value and extrinsic value, right, will fluctuate. So in that case, the actual premium will be fluctuating as things change. Now, one thing to keep in mind, as implied volatility goes up, extrinsic value goes up. They are strictly correlated together. As implied volatility goes down, extrinsic value goes down. All right, so keep that in mind. We'll go into more details in part 3, but keep that in mind. That's how things fluctuate, because as implied volatility goes up, extrinsic value goes up. As implied volatility goes down, extrinsic value goes down. Now, extrinsic value will also decay as time passes, because you are then paying each day, and we'll get into this when we talk about the deltas and everything in section 4, but as time passes, the extrinsic value will start to decay each day. So that'll be the price you pay to actually, the price to play, if you will. If you think about it, if a stock price stays flat, doesn't change a whole lot, then you are going to be losing extrinsic value. So, and we'll talk about that when we talk about price decay and theta decay and things like that. The other thing to keep in mind is the more time it takes for the contract or the option to mature, so the longer it is to get to the expiration date, the more chance it has of having more implied volatility, right? So the longer the contract lasts, the chances are, the stock prices can go up and down, more volume on the options, right? So you're giving it a bigger time frame for things to start happening to make the price go up or go down. The negative to that, right, is that it's more expensive, right? So the further out the expiration date, the more expensive that premium is going to be. So there's a little bit of a trade-off there. So as time goes on, the extrinsic value is going to start decreasing because the time to maturity is getting closer. Theta decay is kicking in. We'll talk about that in a little bit. And possibly even implied volatility is going up and down. Now, if it gets to the date of expiration and the contract becomes worthless, you can't lose more than the premium that you paid. Okay, so that's the good thing. You can't lose more than you've actually paid. The other part of that is, as it gets closer to expiration, right? If the stock had gone up, your intrinsic value then goes up. And the idea is to sell this $50 call that you bought for $5.50 for more than that $5.50, right? So as implied volatility goes up or the stock price goes up, right, the difference between the current stock price and the strike price that you bought this options contract at becomes greater. So the intrinsic value then goes up. So the idea here is to try to buy this option as low as possible, right, and then sell it higher than what you bought it for. That's the whole idea behind buying and selling on the stock market, whether you're buying shares or buying options. Buy low, sell high. Most people will not exercise this option. Now, exercise means you're actually going to pay $50 for 100 shares of this contract, right? Most people do not exercise. What they do is they will try to buy this contract with a low premium, wait for the stock to go up, wait for implied volatility to go up so that the price of that premium goes up, and then they sell it for that higher premium and they keep the difference. So for example, if they buy this contract at $5.50 and the stock price goes up, right? So let's just say now goes from $5.50 because the stock price goes up, implied volatility goes up. Now the premium is $7.50. Now you can sell this contract that you bought for $5.50, sell it for $7.50, and you've made $2 per share for 100 shares. That's $200 profit. Okay, so I think I've thrown a lot at you in this section, so I'm going to take a pause there, and I want you to think about a few different things. What is intrinsic and extrinsic value? Why do out-of-the-money options have no intrinsic value? Number 3, how does time to maturity and implied volatility affect the premium price? And if you understand those 3 things, then you're great. You're ready to move on to section 3. Again, I really appreciate it if everybody could subscribe to my channel. If you like this video, if it's been helpful and informative, please hit the thumbs ups. Like this video, add some comments below, help me make these things a little bit more valuable for you. And as always, if you'd like to support myself, the channel, or even our Discord group, you can find the link to that in the description of the video. Please feel free to subscribe or use my referral link for Robinhood. You get a free share, I get a free share. It helps support the channel as well as the Discord group. Or you can always send a really nice thank you via Venmo at Jonathan Van Horn. Again, I appreciate everybody's time. Thanks, and we'll see you next time.